Hi, I'm Miranda Carr, Chief Investment Officer at the Trust Company of Tennessee, and I will be covering what happened in the markets and the economy during the second quarter of 2025. You may recall the large drawdowns we saw in domestic equity markets during the first quarter, but we saw a huge rebound in the second quarter. And this was related to optimism over trade policy and the markets really just shrugging off a lot of the concerns that caused volatility in the first quarter. The Fed funds rate remained unchanged, but other rates across the yield curve fell. And since when interest rates go down, bond prices go up, we saw positive returns to most sectors of fixed income during the quarter. US large cap stocks were up 11% for the quarter, and US small cap stocks were up 8.5%. We really saw a continuation of the trend of the last couple of years of investors favoring those large and even mega cap names in tech. International developed and emerging markets had another good quarter with favorable tailwinds from falling inflation, easing monetary policy, and improved sentiment. Real asset performance was a bit mixed. Commodity prices fell, and investors also sold REITs during the quarter. Now, this page is a bit busy, but I'll walk you through each quadrant. So, starting at the top left, I think it's important to note that the economy is slowing. Now, it's not quite stalling yet, but the data were softer in the second quarter. We did get a negative GDP print for Q1, which was largely attributed to the surge in imports. So companies and consumers wanted to stock up ahead of announced tariffs. They imported a bunch of stuff. And so the net exports, which is part of the calculation of GDP, takes how much we export minus how much we import. So you can see that was a drag on the overall number. In my view, though, the slowing growth in consumption was more concerning. So the consumption component is the biggest piece of the economy. And when the consumer pulls back on spending, that's when you can start to see ripples begin across the economy. And ultimately, the fear is that businesses stop hiring or even start cutting jobs. And that's ultimately the biggest problem with recessions. Now, to be clear, that's not yet happening. As you can see on the graph on the top right, the unemployment rate is still near historic lows. The labor supply has not been growing as quickly as the economy over the last few years, and companies have had a hard time finding the workers they have needed. So, economists are expecting that companies will be slower to do layoffs this cycle. And in fact, the economy continues to add jobs. It's certainly at a slower clip than we've seen over the last 5 years, but at this point in the cycle, we are still observing job growth and low unemployment. Turning to the bottom left chart, this shows the yield on the 10-year Treasury. The orange line represents what we call the nominal yield or the stated yield. This is the yield that you can observe, the yield you get paid. The 10-year ended the quarter at 4.24%, which is higher than we've seen since the financial crisis, but obviously quite a bit higher than the near zero rate experienced since then. The main reason I wanted to include this chart is because it shows real yields. Now, real yields take the nominal yield and subtract out inflation to determine what income bondholders are receiving after adjusting for inflation. And this has been a big topic of discussion over the last decade plus, when real yields were actually negative and bondholders weren't receiving anything after inflation. Over the last 70 years, real yields have averaged about 2%, and it's clear from the chart there's been a lot of variance around that average, but in general, it's good for the economy, for savers, for bondholders to earn a real rate of interest. In fact, there was a real concern over the last decade about this phenomenon of bondholders earning an interest rate that was below the rate of inflation, and this came to be called financial repression. There are multiple papers written on this and how it's good for governments to inflate their debt away by keeping yields lower than inflation, but it's not good for citizens. It's not good for the lenders, for the savers, for people in or close to retirement who need an allocation to bonds. So while I view it as a good thing that we are seeing positive real yields, the fact is that the real yield is still below the long-run average currently. So this means that current monetary policy is more accommodative than it has been in the past. And inflation is still running above the Fed's target of 2% per year. So it makes sense that the Fed is waiting to see the impact on inflation of the tariffs before they lower rates, especially with a relatively healthy labor market. In this country, the Fed has a dual mandate. They are tasked with targeting full employment and price stability. So every move they make with monetary policy with setting rates and non-traditional tools, they're thinking about both. They're thinking about keeping inflation right around 2% and making sure the public believes it will remain there, while also making sure to not push unemployment up too high while they are keeping policy sufficiently tight to hit the inflation target. And they've done a really great job over the last few years bringing inflation down without pushing the economy into recession and seeing unemployment spike. So that's a little bit about what's going on, why we haven't seen that Fed funds rate come down yet. It's because inflation is still higher than the 2% target, and we still see a healthy labor market. So economic growth is slowing, but employment and inflation are not yet flashing red. There are a lot of headlines that are concerning, though, whether it's around layoffs or geopolitical events, and it's really tempting to sell and just get out of the way of the risk. But I think the bounce back we saw in the second quarter really underscores this point of how important it is to stay invested. The S&P 500 was down 19% from its high early in the quarter and actually hit its recent low on April 8th. Then sentiment changed. And to reiterate, nothing actually got resolved. We don't have clarity on tariff policy yet. We haven't gotten a proclamation that there will be no tariffs. And yet the S&P 500 closed the quarter up 25% from its low on April 8th. That's a huge run. That's multiple years of return happening during the quarter. And the market always turns around before the economic data do. This is true on both the upside and the downside. So the chart on the bottom right of this page shows that if you just ignore the bad news and you stay invested, you have the best possible outcome. Over the last 30 years, if you had just bought into the stock market or even the bond market, you would have handily beaten inflation. But the actual return to the average investor was 3%. And this is based on a comprehensive study that looks at trades in and out of funds to kind of triangulate what people are actually doing. So when they're selling, when they're holding cash, and when they're buying back in. And it turns out that this is also true for professionals, but professionals and non-professionals are not very good at timing the market. So people tend to sell after things have gone down, and they tend to buy once things have recovered and they feel more comfortable. So if you're feeling nervous about the state of the economy or the state of the world, go shopping or eat some ice cream, hug your dog, but don't liquidate your investment holdings. And our relationship managers are always happy to chat with you. We're here to be your guide, talk through this with you. So if you're feeling nervous, give us a call. We're happy to share our perspective or do the math with you on your plan to see what level of risk you actually need to be targeting to achieve your goals. But ultimately, we want to make sure to allocate your assets in the way that will help you reach those goals and make sure that you stick to that, whether there are headlines saying that things are going really well or whether there are headlines that are more concerning. Taking a closer look at the equity markets, gains were pretty broad-based, with tech stocks leading the way. You can see energy and healthcare companies were negative for the quarter. And below, you can see that growth outperformed value and that large companies outperformed small companies in the US. And if we look at global equity markets, the chart on the left shows how various countries' markets performed in their own local currency, and then also how they performed in US dollars. So what that experience was for US investors. Now, the dollar has been declining this year, and that has been a tailwind year to date, which has boosted those returns for US investors. But all major markets in Europe outperformed the US market even before the currency impact. The aerospace and defense sector, as well as the financial sector, had very strong gains. And for years now, we have been pointing out that international companies were trading at a historically steep discount relative to their US counterparts. So with very full valuations in the US, international equity valuation multiples looked very attractive. So we didn't know what that catalyst would be to start seeing those multiple increases, but that is exactly what happened in the first half of the year. We saw multiple expansion. It was the main driver of performance. And even with those higher multiples here, the Eurozone, Japan, and even emerging markets are still trading closer to the bottom of the 20-year historical range than the top. So multiples still look pretty attractive, especially relative to the US, even with the gains we've seen. Turning to fixed income, if you look at the return column in the chart on the left, you can see positive returns for the first half of the year, except in the muni bond space, which does have a longer duration than corporate, and there are a few specific idiosyncratic risks showing up in the muni market this year. But if you look at the chart on the right, which we include every quarter because I think it's the best way to understand where we are in fixed income, what this is telling us is that it's a great time to hold bonds. So you're currently getting a 5% yield on investment grade corporate debt, about 4.5% on the US Ag. So if we think about broad fixed income yielding 4.5 to 5%, some clients will say, well, I can get about 4% in money market. So why don't I just hold cash? I can get 4% just holding cash in the bank. And yes, you can. So why would you own bonds when you can hold cash? And it's due to the fact that when interest rates fall, bond prices go up. So that navy bar on the chart shows us if interest rates fall by 1% and we're back at 3.5% yield on the US Ag, the price of those bonds yielding 4.5% will go up. So your total return in that scenario is 11%. So when do rates fall? Rates fall when economic growth stalls, or when there's a lot of uncertainty about the future, when unemployment starts to rise. So all those things that cause equity markets to fall also cause interest rates to fall. And that's why bonds are a better hedge to equities than cash in most environments. The yield on cash will fall immediately once rates fall, and you won't get any gain on the market value of your cash. So we do recommend an allocation to fixed income if you're trying to hedge your equity risk. And I want to illustrate one final point on holding cash because I know it's tempting to do so when there's so much uncertainty. This graph looks at returns going back to 1995. And what we see is that a portfolio that is invested 60% in equities and 40% in bonds outperforms cash most of the time, even in the short term. Now, if you are about to spend that cash, definitely keep it in cash. This point is really focused on your investment accounts that are meant for the long term. But even if you only have a 5-year holding period, the 60/40 has been positive 99% of the time, and it has outperformed cash returns 80% of the time. Over a 1-year horizon, the 60/40 has outperformed cash 80% of the time. And once you get to 10, 15 years and beyond, the 60/40 has been positive and outperformed cash 90 to 100% of the time. So don't try to time things. Keep the cash you're about to spend in cash with that low yield, and then keep your investment accounts invested to maximize your gains over the long term. I want to wrap up with a review of the REIT market. This is publicly traded real estate property, and one of the great things about REITs is that they have had great returns over long periods of time, but also are not as correlated over long periods with stocks or bonds. They have characteristics of both. So in addition to holding bonds, another way to mitigate risk in your overall portfolio is to add other assets with low correlation to the equity markets, and REITs certainly accomplish that. The REIT sector declined by about 1% this quarter, so you can see even within REITs, there is quite a bit of diversification among myriad property types. So this quarter, data centers did well, lodging and resorts were up, but residential fell on some softer economic data. So in summary, it was a pretty good quarter overall in the markets. If you have any questions about any of this or want to discuss your personal financial plan, please reach out to your relationship manager.